This next video, we're going to talk about the three different forms of market efficiency. And this is going to help us determine in our quest to answer the question of are markets efficient. We're going to need to know the three different types and know which one we're actually challenging. So let's go ahead and get started here. First form of market efficiency that was presented here is called the strong form of market efficiency. Now, this one believes that when we're pricing particular stocks or assets, all information, past, present, and future, including private information, we'll highlight that, is factored into a stock price. What I mean is when you are analyzing a stock to buy, that you know all information, past, present, and future, including private information, fact, and you're making that decision into your stock price. But when I'm making that decision, I don't go that far. And certainly I don't know private information. And so when we're talking about all information about a company factored into a stock price, that all participants know this, think about your best friend, somebody who knows you more than anybody. And I want you to think of, are there any scenarios or any situation where that person knows all information about you, including all private information from past, present, and future? And I say, I know my wife knows me pretty well. My kids know me pretty well. I've got some really good friends. Maybe we should just be thankful that they don't know all information, including private, past, present, and future about me. And so when we talk about this strong form, we go, no, that's way too far fetched. That that's not really possible. And so this one can pretty easily get dismissed when we're trying to challenge it because everyone agrees it's really it's impossible to actually capture strong form efficiency, let alone everybody understand that concept about a company. So classical finance went back, regrouped, and said, okay, how about this? Semi-strong form says all information, past, present, and future, and they say all public information, past, present, and future, is known by all participants. Is known by all. Everyone knows all public information that's available to everyone. We have this. All of these companies that are traded publicly have to report and provide all their financials, provide all their information, and it should be known by all. If you're going to invest money, then you should know all this information. And if we follow all of the other assumptions, we should all agree on the same price of this stock or the value of the stock. And so all public information is known by all. This one actually is a bit, we settled on this in classical finance for quite a bit because it was really tough to disprove or tough to question. Along came in the 1980s, this was Joseph Stiglitz. He came up with what we know as this information paradox. And this was one of our first questions around semi-strong. And we call these questions or challenges to these market efficiency. This information paradox, remember, paradox go in circular motion, so you can hopefully stay with me on this, and hopefully I can explain it the right way, is that if all information, public information, past, present, and future, is known by all, then what is my motivation to seek out this information? That's all already baked in and it's already known by everybody. Why do I have motivation to seek out information? But if I am not motivated to seek the information, then not all people know all the information. See the circular logic here? I'll write it out here. If all available info is known by all and reflected in stock prices, nobody would be motivated to get the information. To produce or gain information. But then, if that's the case, then prices could not reflect this information. But then prices could reflect this lack of information. Lack of information. So once again, we have this circular motion, and if all available information is known, we're not going to go find it. And if we're not motivated to find it, then the whole system breaks down. So it just challenges the fact that this whole semi-strong information, this known by all assumption here. Then we have weak form. So this one's still up in the air. We have some questions around this. And then weak form is the third. And it says that historical prices and returns are known by all participants. And all investors. So if the historical prices, think about charts, looking at a chart using technical analysis some traders use that would say weak form, if this holds up, everybody should know the historical prices and returns. And so by going back and looking at trends and charts should not give you any additional information on this weak form efficiency. Additionally here, in addition to this information paradox, going back here, the semi-strong form, if we were looking at all public information being known by all, besides the information paradox, what is the only way that you could actually earn profits, excess profits after factoring risk? If all public information is known by all? The answer, most people would say, is that if you obtain private information, that would be your only way to beat the market, is by knowing what the public doesn't know. And the only way in this assumption is that private information is your way to those returns. When we're looking at weak form, we talk about technical analysis. And so if you believe that technical analysis has some benefits to it or excess returns, then you are challenging weak form market efficiency. And so I've written academic papers on technical analysis and done research in different aspects of it, and have found to a varying degree, there are some markets and some data sets that have excess returns after factoring risks. They're not huge, but then at the same time, it's not always consistently positive returns over all different markets and all different times. And so that is still up for debate. There's no real consensus, but you'll still have some people who really believe in it. And sometimes when you have enough believers in technical analysis and everyone's looking at these charts, it becomes this self-fulfilling prophecy. So sometimes if you're tracking technical analysis charts, you'll see it bounce at some times where it's hitting the resistance or the floor line here, and you can see them bounce up. You go, oh, wow, people are still using this. Now, the only way I have known to 100% lock in profits for technical analysis, even after writing papers on this, is to write a book on how to trade technical analysis. That's really the only guaranteed way of making profits on there. And that is my dad joke for the video here. Hopefully there's not too many more left. But on the next video, we're going to finish out our conversation about this whole efficiency. And we're going to talk about this joint hypothesis problem that still leads us to debate between classical and behavioral finance to this day. So I'll see you on the next video. Thanks for hanging in there.